Hello everyone. Group 5 will present topic 7. This is our rough table of contents. First, we will talk about introduction, argument 1, argument 2, conclusion, and finally references. So this is our root diagram. We will talk about two arguments. The first one is the impact of short-termism on investment, innovation, and R&D in non-financial firms. The second one is financialization changes the way non-financial companies are managed, making innovation difficult. So next, I will talk about the introduction. So in today's business environment, many non-financial companies struggle to innovate. One of the main reasons is financialization. The trend of businesses prioritizing financial returns over long-term investment in research and development. First, short-termism causes companies to focus on quick profits instead of investing in innovation. As pressure from shareholders and financial market grow, R&D budgets are cut, slowing down innovation. Secondly, financializations changes the way businesses are managed, making it harder to stimulate innovation. Companies are increasingly driven by financial goals, such as maximizing dividends and buying back shares instead of focusing on developing new products and technologies.
Hello everyone, my name is Kim Ngân, and next I will present a part knowledge worker and working conditions that support knowledge workers. So what is knowledge worker? They are highly skilled or experienced individuals who work is mainly based on creation, analysis, application, and convey knowledge. And the next is working condition. Firstly, let's talk about the job characteristic model, GCM. About the job varieties, this means that a job requires performing a variety of activities and skills. The more varied the job is, the more opportunities that employees have to learn and grow. Secondly, job significant. This represents whether the job impacts others, and a meaningful work will strongly motivate employees to create more value. Thirdly, job feedback. When employees know what they are doing well or need to improve, they will have a more appropriate direction for development. Fourthly, job identity. This related to whether a job requires completion from start to finish. Finally, job autonomy. This is the extent to which employees can decide when and how to perform tasks. These flexibilities allow them to be more productive and creative. According to Humphrey and Colleges 2007, they found that JCM has a significant impact on job satisfaction, motivation, and organizational commitment. In particular, experience meaning plays an important mediating role when employees feel their work is meaningful, they are more productive and engaged. Moreover, the work environment has a big impact on innovation. A good environment gives employees the motivation and resources to innovate. First, interpersonal relationships are important. A culture of trust and collaboration helps employees integrate quickly and feel recognized and be willing to contribute new ideas. Next, hierarchy. When employees are involved in the decisions and work as a team rather than being dictated, they have a better chance of being innovative. And the nature of work also plays a key role. Companies should flexibly assign challenge work with adequate resources to encourage employees. Finally, a fair reward and support system can motivate employees to find creative solutions rather than focusing on short-term performance. Besides to foster innovation, businesses need to build a strong organizational culture. Firstly, encourage participation or involvement. Business should need to create conditions for employees to contribute ideas, share value, and innovate. Secondly, maintain a consistency. It is necessary to clearly define how to achieve consensus and ensure unity among groups, but still be flexible when necessary. Third, increase adaptability. Businesses should build standards that help employees easily accept and respond quickly to changes from the external environment. Finally, define a clear mission not only guides strategy but also motivate employees. However, the financialization of company has affected the work conditions of knowledge workers. So what is financialization? Financialization can be defined as the process in which financial system plays an increasingly central role in the company, with profits and growth coming mainly from financial activities rather than from production or trade of goods and services. Next, my group represents some arguments to support the idea that financialization can harm innovation.
Hi guys, my name is Vâng and I'm gonna tell you about the first argument, which is the impact of short-termism on investment, innovation, and R&D in non-financial firms. First, I'm going to tell you how growing influence of institutional investor. As we know that pension funds, hedge funds, and insurance funds play a significant role in financial corporations. These investors allocate the funds to both institutional investor and non-financial corporations. The key issue here is that a primary the goal is financial return rather than the long-term innovations or roles. Because of this, non-financial corporations are pressured to meet the investor expectations, often shifting their focus from R&D to financial activities like stock buybacks and dividends. This leads to a process called financialization, where financial market gain greater control over the corporate decision making. Companies are not only put under pressure by institutional investor, but also the financial market. Resident, ordinary people like us invest in the firms. In turn, the companies have to return the pension funds, hedge funds, and insurance funds, as well as the mutual funds when the resident need. The the company have to ensure they can pay back the withdrawals as soon as requested. Therefore, the non-financial corporations must balance their investor expectations with their ability to innovate and remain competitive in the long run. This creates a cycle where institutional investors are forced to seek the quick profits to meet these obligations, and as the result, they put the non-financial corporations to deliver intermediate financial returns, reducing the resources available for the long-term investment, such as innovation and technological advancements. Let's have a deeply understand from this. On the right side of the diagram, we can see the financial markets and their goal to make a profit in the short run. Institutional investors prefer predictable financial returns, so they push the firm to limit R&D spending and instead of focus on strategies that generate intermediate profit. On the left side, we can see we have the innovation requirement, we can understand that financialization discourages investment in innovations because R&D is expensive, uncertain, and has the long-run development cycles. This creates a fundamental conflict. The corporations that focus on the financial return will hesitate to invest in innovation because it does not provide any intermediate results. Over time, this slow down the technological progress and reduce the competitiveness. Next, my friend Lang, I'm going to tell you about another supporting idea for argument one.
As businesses focus on maximizing shareholder value, the gap between management and employees becomes clearer. Agency theory suggests that growing shareholder wealth often comes at the cost of worker wages and benefits, worsening labor inequality. Pressure from financial markets pushed companies to prioritize quick returns for shareholders. This led to a divided workforce. Low-skilled workers face stagnant wages and few growth opportunities, while executive and shareholders reap the biggest reward. Financialization also changes how companies measure productivity and value creative work, especially for knowledge workers. With less investment and in innovation, employee motivation declines, driving businesses further toward short-term gains instead of long-term growth. So next, we will move to the impact of financialization on non-financial organization. Financialization has led to aggressive cost-cutting measures that significantly impact employees and workplace dynamics. Many companies resort to downsizing and workforce reduction, forcing remaining employees to take on heavier workloads. At the same time, senior management exert tighter control while cutting budgets for creative departments, limiting innovation and long-term growth. Job security has also been compromised, especially employees are increasingly pushed into short-term contracts, creating a sense of instability. Additionally, working conditions have worsened, with reduced pension, fewer leave benefits, and major cutbacks in employee welfare. These changes not only affect individual workers but also weaken overall organizational sustainability. Many companies prioritize short-term gains over long-term growth to recover capital quickly. They go public, sell assets, or outsource to push cash flow, but these strategies often weaken long-term stability. Focusing on quick profits, businesses shift from sustainable investment to financial tactics, reducing innovation and R&D. Globalization accelerates this shift, pushing companies to outsource, which cuts costs but increases risk like quality issue and reliance on external partners. By prioritizing short-term profits, companies limit creativity, slow product improvements, and risk losing their competitive edge in the long run. And finally, we will move to the impact of short-termism on innovation, research, and development. Short-term financial goals increasingly dominate non-financial cooperation, even in industries that rely on innovation, research, and development. Innovation comes with risk. It needs a big upfront investment, take time to develop, and often pays out only in the long run. But when companies focus too much on short-term profits, they often cut or delay innovation, hurting their future growth. This short-term mindset also affects employees. Skilled workers are pushed into short-term contracts, making jobs less stable. Worse working conditions like fewer benefits or lower pension hurt motivation and limit creativity. In the end, chasing quick profits over long-term investment weakens both innovation and a company's competitiveness.
Okay, thanks, Lang. Let's move to the argument two. Financialization changed the way non-financial companies are managed, making it in a ways difficult. First is 2.1. Financialization changed organizational management, put pressures on knowledge worker. As in non-financial companies become financialized, the primary goal is no longer product develop or innovate, but rather to maximizing the profit in the short term. This put enormous pressure on the knowledge worker who need the flexible environments to research and innovate. According to Cousins in 2013, studied 25 employees in the British multinational companies and found that as the company become financialized, knowledge workers are forced to follow the financial criteria, like increasing the ROI, reducing the cost, rather than being evaluated on their creativity or expertise that leads to higher stress and demotivations. Instead of evaluating the employees based on their creativities, companies increasing focus on financial metrics such as the revenues, the quality profit, or the stock price. They cut the budgets of long-term projects and tightened control, making the employees feel constrained and less likely to experiment with the new things. 2.2 work designs change. Knowledge workers lost their motivate to innovate. So financialization not only changed the way management is done, but also make the employees work more mechanical. Previously, they could actively research and propose a new idea, but now they have to focus on completing the financial KPIs set by the company. This leads to a clear consequence is focusing on the quantity over the qualities. Employees no longer have to think deeply about innovation. They only have to try to achieve the short-term financial goal. They work under closer supervisions and have to report continuously, causing creativity to gradually disappear. So, for example, in the pharmaceutical industry, many companies continually release slightly improved versions of the own drug to maximize the profit rather than invest in the truly groundbreaking drug research. The Roosevelt Institute creation of crisis why the pharmaceutical industry choose profit over people, analyze how policies in the United States have to lead to high drug price, low investment in healthcare, and skyrocketing CO paid in the pharmaceutical industry. The report they argued that The regulations and the antitrust policies have encouraged the pharmaceutical industry to focus on profit rather than patient health. This had led to the pharmaceutical companies justifying high price by citing the need to fund research and develop R&D, when in reality the majority of profits are used to buy back the share and to pay dividends to the shareholder rather than invest in R&D. In addition, the report highlighted that the current patent system create market monopolies, allow pharmaceutical companies to maintain high trend price and limited competitions. It's not only affect the patient access to medicines, but they also to reduce the incentive for innovation in the industry. To portrays implication for knowledge worker and innovations. So when the work environment becomes stressful due to the financializations, knowledge workers are easily demotivated to innovate. They feel that their work is no longer meaningful because the new idea often enough if they not bring immediately profit. Moreover, the turnover rate increase. Competent employees will look for the other workplace with new suitable environment to develop. Therefore, the company gradually lost the best people, the people that who can help them innovate. Ultimately, this makes the company culture more conservative. When everything revolves around money and money, the company will not dare to try new things, only focus on what is safe and less risky. In the long run, will weaken their competitiveness.
Overall, financialization is hindering innovation in non-financial firms by promoting short-termism and changing management priorities. When firms focus on financial returns rather than long-term investment in R&D, innovation slows down, limiting the ability to develop new products and technologies and affecting the competitive advantages. And our suggestion is to maintain a competitive advantage based on innovation. Firms need to balance the short term financial gains with long term investment strategies in innovation. And this is our references. Thank you for your attention. Goodbye.